All right, well, welcome everyone to the final seminar for the Australian Non-Profit Accounting Standards Research Program. We've got a great seminar today produced and presented by Angus Thomson, who is currently the manager of the joint AASB New Zealand Accounting Standards Board project on applying AASB 17. And he's going to talk to that in the context of the public sector, but also, I think, Angus, make a couple of comments in terms of private sector as well. Angus will talk for about 30 to 35 minutes, and then we can have a few questions or comments. And I'll hand over to you, Angus. Thank you.
Thanks very much indeed, David, and our select audience. As David said, this is a joint project, and I guess it's important to mention that currently we have 100% alignment in the accounting standards in the insurance space in Australia and New Zealand. So that's across all sectors at the moment. They might be called different things. So AASB 1023, which is the main Australian standard, is an appendix to PBE IFRS 4 and indeed NZ IFRS 4 in New Zealand. Both of those, all of those standards apply equally to the not-for-profit, private and public sectors. Now, that's kept pretty well everybody happy to date because the standards are very much principle-based and they were written with both sectors in mind. Along comes IFRS 17, and both New Zealand and Australia have adopted those standards for periods commencing on or after the 1st of January 2023 for their for-profit sectors, and indeed their not-for-profit private sector. The issue has been, what do we do in the public sector? Do we need to do something different? And the reason that's arisen is because IFRS 17 has been written very much from a private commercial perspective. So it has a number of things in it that might need to be modified to best suit certainly the not-for-profit public sector. So the plan at the moment is that we will issue an exposure draft early next year, and we're going to propose a 2-year delay effectively. So public sector entities won't need to apply the new standard until we get to their 30 June 2026 financial statements. That might seem like a long way off, but you've got to do a comparative year commencing in July 2024. So it's not really that far off. Just looking at the landscape, there aren't that many entities. About 20 Australian entities currently applying AASB 1023 and 2 in New Zealand. Now the 2 in New Zealand are pretty big. One's the Accident Compensation Commission. And if you know anything about the New Zealand situation, anyone in New Zealand is covered for accidents, basically. Even if you're a tourist and you trip on the footpath, you can potentially make a claim under the Accident Compensation Commission scheme. So it's a very big scheme. Just to give you a bit of a handle on how large the public sector is in terms of insurance, the general insurance industry in Australia in terms of gross written premium is about 75 billion a year. Life insurance is about 22, and private health insurance is about 25 billion as well. The government sector is also about 25 billion. So it's right up there with those large commercial sector insurance arrangements. In New Zealand, I'd say probably about $1 in $4 of premium is with government insurers, and that's largely because of the size of the Accident Compensation Commission and the Earthquake Commission. So it's a fairly significant sector. The big differences between what we have now and what is required under IFRS 17 is largely in terms of the liability for remaining coverage. Now that's the liability for things that haven't happened yet, as opposed to the claims liability, which relates to things that have happened in in the past. There's also a notion, and I'll go through these in a bit more detail shortly, there's a notion of a contract boundary that we don't currently have. The risk adjustment requirements are different, and there's a lot more granular accounting when it comes to IFRS 17 compared to our current standard. The big ticket issue for the public sector is what falls into 17, or what's an insurance contract in the public sector versus what isn't, and is, for example, just a compensation scheme that you would apply the provisions standard to. And so we've got a number of indicators that we're proposing in the draft exposure draft. And the top one is that the sort of risks being covered and the sort of benefits being offered are similar to insurance. And if you look at that, for example, there's a bit of a patchwork of coverage across Australia and New Zealand. So in WA, for example, compulsory third-party personal injury risk, that's for accidents with moving vehicles, that's covered largely by a private sector scheme. No, sorry, that's a government scheme in WA. In New South Wales, it's a private sector scheme. In Victoria, it's a government scheme. So it just varies from state to state. If you look at workers' comp, in WA, that's a private sector scheme, but in New South Wales and Victoria, they're public sector schemes. So you can see there are markets across the country in which both commercial private sector entities are participating, and they're basically the same markets that the public sector is participating in. So that first indicator would help determine, for example, whether things fall within the insurance standard or not. So you would imagine if the same contracts are being sold in both sectors, that would indicate that it would be insurance. Having said that, though, these indicators are supposed to be considered collectively. No single indicator is necessarily going to say that you're in 17 or outside 17. The second one is that there's an identifiable coverage period. And the best way to explain that is to say that, well, the aged pension isn't insurance because there's no defined coverage period. If you've achieved age 60, whatever it is now, 67, and you're alive and your income is below a certain level, then you're entitled to the age pension. So there's no particular coverage period, which under an insurance contract, of course, you would expect to be told, well, you've just insured your car for a year. So we're not talking about eligibility criteria defining that boundary. There's an actual coverage period in the contract. The other one is that it's binding or enforceable. So typically for an insurance contract, it'll tell you what you're entitled to. So if X happens, if there's a flood and you're covered for flood insurance, we'll replace all your floor coverings and repaint your house, whatever it might be. Whereas in some of these other benefit schemes, which are not insurance-like, governments can turn around, for example, and say, well, this year we're compensating people for average weekly earnings of 50%, but if the money runs low, it'll only be 25%. So it's not binding on the government. The government can actually change its mind on how much compensation you receive. So if it's binding and enforceable, that would imply that it's within 17, and if not, that would imply that it's not. Source of funds is another indicator. And so if you're getting a levy or a premium from the person who stands to benefit most, that's similar to selling an insurance product and getting a premium off a policyholder. So again, the source of funds, the more of the funding that comes from the actual participants who stand to benefit from the scheme, the more likely it is that it's insurance and will fall within 17. The next one is that there's earmarked assets. So in other words, rather than just relying on appropriations, which a lot of government schemes do. So, for example, the NDIS, David mentioned earlier, that's really funded completely on appropriations. The funds aren't sourced from the participants necessarily, they're sourced from taxpayers more generally, and there's no earmarked investment assets backing the NDIS. That's an appropriation every year out of general revenue. And then the last one there is just that the management practices are similar to those conducted by insurance operators in the commercial sector. That would make it more likely that it's insurance or not. And I guess by way of example, what I would say is what's going to fall either side of the line. In Victoria, we've got the Transport Accident Commission. And so if there's a transport accident of any type, it's covered by the TAC, and the TAC is traditionally applied insurance accounting. However, in a lot of states, so for example, New South Wales and Queensland, and indeed in WA, there's a split between very serious catastrophic injury versus the rest. So in a lot of cases, the normal, I'll call it normal non-catastrophic injury, is treated as insurance, but the catastrophic injuries are treated as a compensation scheme. And so you can see there's a patchwork of application of the standards across Australia, and we're trying to get to a position where there's more consistency. And so that's one of the points of having these indicators, trying to make sure that we get the same arrangements sitting inside 17 or outside 17 across all the jurisdictions. One of the things, one of the features of our existing standard is that if the contract says it's a year, we just assume, okay, it's a year. We don't have any principles around that. We just accept whatever the legal contract says. IFRS 17 doesn't do that. It says that, well, the contract boundary ends when you've got the practical ability to reprice the contract. And if you're doing it on a portfolio basis, it's at the point where your pricing is reassessed. Now, the problem we've got in the public sector in particular is that, for example, in New South Wales, or Victoria is probably a better example, or indeed the CTP scheme in WA, it could be that if CTP in WA was run as a private sector scheme, in the next pricing cycle, they might say, well, we've really got to bump this up by $300 a year because the claim position has deteriorated, and so we should be increasing premiums by a lot. But the government might say, well, no, we'd rather smooth that increase over a period of 5 years and not have a big jump in premiums, because this is something everybody's got to pay. People are on high incomes, low incomes. So there could be a public policy reason why you don't necessarily price your contracts fully in any particular year. Now, the issue with that is if you've got a long-term pricing strategy, that all of a sudden under 17 turns it into a long-term contract. So if you're putting through price increases over 5 years, you'll end up with a 5-year contract. Now, does that accounting under 17, saying that's a 5-year contract, where you would then project out all the cash flows that you predict for 5 years, is that going to be useful? And the board has said, no, look, we don't think that is useful. So they're proposing to modify the standard and say, look, notwithstanding that there might be in the background some sort of long-term pricing strategy going on for public policy reasons, you would ignore that for the purposes of determining the contract boundary. So that would flip you back to an annual contract boundary. And one of the other significant things about that is that there's, and I won't go into any detail on it, but there's a very complicated method of accounting where you project all the cash flows for multi-year contracts. And what you probably want in the public sector is to keep everybody eligible for what's the simplified model, which is based on the premiums received and claims paid. And so there's a lot riding on the term or the coverage period. If the coverage period exceeds a year, you're then challenged and possibly having to apply this much more complicated measurement model, which the board really wants to avoid. Under our existing standard, there's a risk margin as well. So typically, if you looked at the CTP claims liability in WA, you would see that what they do is they top that up to a 75% confidence level with a risk margin. Now, what that means is that 3 years in 4, you would expect that amount of cash to meet the claim liabilities. And in 1 year in 4, it wouldn't. So that's your 75% confidence level. That's become a sort of industry practice, very widespread. And it's based on the inherent uncertainty in the cash flows. And you can actually calculate that inherent uncertainty to get, so you can actually, it's quite easy to calculate a dollar amount once you've determined that you want a 75% confidence level. What IFRS 17 does is it says, well, you should base your risk adjustment on the compensation that the entity requires for the uncertainty. And once you shift to that principle of what's the compensation required, then the entity has to ask itself, well, what do I require as compensation? And it could be in the public sector because you've got a monopoly position. So if you want to drive a car in WA, you've got to buy insurance from the government. There's no choice. So they're in a monopoly position. If they had bad claims this year, in theory, they can just charge more next year. There's also an implicit government guarantee that if claims are very high, then the government will come to the rescue with an appropriation. So in the public sector, you could argue that the compensation required is zero. I don't need to provide anything for risk because all my risk is actually borne by participants because I can just put price increases through next year, or it's borne by the government that owns me because I can always ask for more money. So the issue becomes, do you really want public sector entities deciding that they've got a zero risk adjustment? The problem with that is, once you do that, you don't get any idea about what the impact of changes in inherent uncertainty in the cash flows does to your liability. And there's actually information value in that. So on that particular point, the AASB and the New Zealand board have actually made different decisions. The AASB has decided that they'll just allow public sector entities to apply the standard and work out whether or not they have a risk margin on the basis of whether or not they believe they need to be compensated for risk. Whereas the New Zealand board said they don't want entities to come up with zero. They actually want a risk adjustment. And they're setting a rebuttable presumption of 75% confidence level for the risk adjustment. One of the other big changes from our existing standard that arises under IFRS 17 is there's a lot more granularity in the accounting. So the basic unit of account under AASB 1023 and the existing New Zealand standard is the portfolio. And so if you looked at CTP risk in WA, that is one portfolio. However, under 17, that requires you to break a portfolio into parts, essentially at least 2 bits, onerous contracts and non-onerous contracts. Now, typically what you would expect in the for-profit sector is that insurers are trying to make money out of every contract they sell. So having an onerous contract isn't something they're intending to do, but they might actually identify them at initial recognition, and that could be because they're trying to gain market share and they're deliberately underpricing, for example. So what IFRS 17 requires them to do is to identify subgroups within a portfolio. So there's a subgroup of onerous contracts assuming there are some, and profitable contracts. In the public sector, you've got to flip that on its head, because usually they are actually selling, well, they're aiming to break even over the long term. But typically, the way they determine their break even is that they factor in investment earnings into their calculation. Now, typically, long run investment earnings are about 6 or 7%. And the discount rate you apply to your insurance liabilities is a risk-free rate. So let's say at the moment, that's typically about 1.5%. So there's this big gap. If you run your numbers at the moment, and what you'll see if you look at any financial statements issued, for example, by the Western Australian Insurance Commission, you'll see that they automatically have onerous contracts every year, and then they make up the difference with their investment earnings. So what you would be doing if you required them to split onerous and non-onerous in an IFRS 17 context is you would be forcing them to seek out their profitable contracts. And normally they would actually be able to do it, because what you'll find is, and look, I'm guessing here, but I would say if you looked at postcodes in Perth, you could probably identify profitable postcodes and unprofitable postcodes. And that's the same in all the states and territories. Usually there's enough information to work out where you're going to make profits or losses. So you would effectively be requiring these public sector entities to dig down into their data and identify profitable contracts from unprofitable ones. And you have to ask yourself that, given that they're not trying to make a profit, what would be the point in doing all that subgrouping? And once you've done the subgrouping, it creates all sorts of complications for your subsequent accounting. So effectively what the proposal is at the moment, that we'll be exposing next year, is to say, well, if there's deliberate cross-subsidisation, then you don't need to split out those contracts. So you probably will end up back with your portfolio level unit of account in the public sector. In terms of other matters covered in IFRS 17, the first time you need to recognise an insurance contract is either when you get the money, the coverage period starts, or you identify that contracts are onerous. Now, as I've just indicated, most contracts are onerous that are sold by public sector entities. And so if, for example, you had a whole lot of contracts starting in July of 2021, and you're sitting there at the 30th of June, you would be bound but not incepted for a whole pile of contracts for next year. And IFRS 17 would say, well, you should recognise them this year because you know they're onerous. And you get to the ridiculous point where, for example, in Victoria and New South Wales, the workers' compensation business is mainly run with a coverage period from the 1st of January every year to the 30th of June in the next year. So in the last week of June 2021, you would know that you've got hundreds of thousands of onerous contracts that you're bound to that are going to cover 1 July 2021 to 30 June 2022 that you would end up recognising as at June 2021. So what that would mean, you'd almost be recognising next year's contracts every year in the current year. And that makes absolutely no sense. So the board's going to propose that we bump that initial recognition criterion based on when you identify an onerous contract. There are a few things where the board looked at making modifications and decided not to bother. So a number of public sector entities would like to see their insurance liabilities discounted using projected investment returns, not risk-free rates. The boards knocked that back on the basis that there's an underlying principle that you don't measure your liabilities based on returns on assets. They're two independent things. In terms of investments, under the existing standards, you're actually required to measure investments backing insurance liabilities at fair value through profit or loss. Under 17, you're not. But the board decided that's fine because in the public sector, in the main, everybody's required to use fair value through P&L anyway, so we don't see a change occurring there. And the other issue is that a lot of public sector entities have a dual role. So not only are they insuring people, they're also conducting community safety campaigns. So for example, I know in WA and Victoria, they're actually responsible for certain types of road maintenance to try and minimise accidents and things like that. So the other issue is, do we need to separately identify that as a cost that's got nothing to do with your insurance? The board decided that that was clear from the standard, and we're confident that that will be actually separately displayed without any intervention from the board. In terms of our timetable, so at the moment we're currently field testing the proposals relating to the indicators, so trying to work out which schemes are within 17 and which fall out. So for example, the Insurance Commission in WA has agreed to field test those proposals, and we're hoping to get some field test feedback before we meet next in February 2022. We hope to issue the exposure draft in about March 2022, be receiving and deliberating on the feedback on the exposure draft in Q2, Q3 2022, and have issued a modified standard in Q3, Q4. Now, our best endeavours are to have the same standards operating across both Australia and New Zealand. As I indicated earlier, though, of course, they've already made a different proposal in relation to risk adjustments. So if we can't bring consistency there, we'll probably have slight differences in the standards. We've also know that Canada and the UK are working on looking at to apply IFRS 17 in the public sector. Canada's a lot like Australia in terms of workers' comp. Most of that business is in the public sector domain. And the UK has got quite a few schemes relating to flood insurance and terror insurance, which they're looking to get IFRS 17 applicable to. David mentioned earlier that we essentially let the not-for-profit private sector on its own when it comes to applying 17. I know a number of them are struggling a bit because they're not going to have the benefit of any of the modifications that we're proposing for the public sector. The reason the board did that is because, in theory at least, the IASB designed IFRS 17 to apply to mutual entities. And you'll see there's a number of references in IFRS 17 to mutual entities, which are by definition not-for-profit. The irony there is that if you look at Europe, which is sort of one of the main jurisdictions where IFRS applies, IFRS is really only mandatory for listed entities. So these mutual entities don't actually apply IFRS in Europe in any case. So one of the ironies is that I think even though it was allegedly designed for mutual entities, I'm not sure that it's going to work that well for a lot of them. And there are only very few jurisdictions in which those mutual entities will be required to apply IFRS 17, and Australia is probably one of them. So look, I'd welcome any questions now or any written questions I can answer as well at your leisure.
Thanks very much, Angus. Any questions of the viewers at all before I take the chairman's prerogative and ask one? In that case, I might just ask, I guess there's two things that come to mind. The first one is, pardon me, what the implications might be in terms of a framework for public sector and whether that's something that is spinning off out of this or which is informing this, Angus. Just wondering if you've got any comments in that regard.
Yeah, I mean, obviously with the existing standard, there are no public sector modifications. So I think there's two things that have underpinned this project. One is, as I mentioned earlier, that IFRS 17, despite the fact the ISB think it wrote it for mutual entities, is not that suitable necessarily for not-for-profit entities because it's got such a for-profit focus.
Yeah.
The second thing is I think there's been a bit of a shift in thinking about just automatically applying standards in the public sector. Well, we've always had a framework for modifying standards, but I think there's a greater emphasis now on looking at what those modifications should be. Perhaps a greater willingness to make modifications to better suit the public sector. And I think because there's some inconsistent accounting going on, you've got very similar schemes currently applying either 137 on provisions or 1023, that because we're trying to get more consistency, which might mean some entities swap out of 137 and into 17,
yeah,
trying to smooth the path a bit for them.
Yeah. No, it's interesting. And the second one is, I guess, just on the not-for-profit front, pardon me, there are a few not-for-profit insurance companies around, of course, as well. And in fact, believe it or not, I'm chair of Paraplegic Benefit Fund, which is an insurance company based in Perth, but operating in Queensland and New South Wales. Are there any further I guess, taking a bit of a selfish view, are there concerns that we should have as people charged with governance of these types of organisations, in your view? Are there things that's sticking out from the not-for-profit insurance perspective that you think we might be worrying about?
I think the onerous contract, non-onerous contract distinction's possibly going to cause you some grief because it might force you to dig in and because obviously if it's a mutual entity, you're probably it's a bad expression, robbing Peter to pay Paul, but you know what I mean. So in theory, what IFRS 17 is telling you to do is tell me what are the profitable ones and what are the unprofitable ones, whereas it's not your purpose. You're basically mutualising all the gains and losses.
Yeah.
One of the things you might find useful, ironically, I mean, I do some work for Malaysia now. The Malaysians are dealing with this because the Islamic finance equivalent of insurance is called takaful. And takaful is usually sold on a mutualised basis. So they have takaful funds which are fully mutualised, and of course they aim to break even. And so there's some literature that they're issuing. There's bulletins, there's 3 bulletins being issued. They're available from, so there's nothing blocking you from looking at those from Australia. So they might provide some guidance to mutual entities.
Yeah, that's a fantastic reference. Thank you. That's brilliant. Any other comments from Belinda or Erica?
Thank you, Angus. Eric is my name. Yeah. It's been a wonderful presentation, but very sophisticated. I was just wondering how much I've heard of this and how much I can apply. I know I do a lot of work in the not-for-profit sector and less of the public sector. I'll just have to figure out if there's anything I'm missing in the not-for-profits that could have arisen from this one. Otherwise, I have no other comment. Thank you.
I think, I mean, one of the things, when you see the exposure draft, and there's a draft exposure draft on the AASB website that was considered at the board's November meeting, the New Zealand board looks at it next week, and there'll be a revised ED for the February meetings. One of the things you might be interested in looking at is the basis for conclusions. I think the basis for conclusions is about 90% of the document, because the boards have felt that they need to justify all the modifications that they've come up with. I think in a broad sense, so just forgetting insurance for the moment, it might be of some interest to you just to look at the board's justifications as to how they came up with the modifications, the ones they rejected and the ones they accepted, because I think that gives an insight into the board's thinking in terms of what they might do on other not-for-profit topics when they're looking at adopting IFRS standards and modifying them for both the public sector and the not-for-profit private sector. So perhaps just leaving aside the nuances of insurance accounting, that basis for conclusions might give you some insight.
Excellent. All right. Well, I think we've reached the end of the conversation. Thank you very much, Angus. Appreciate that. Thank you to Eric and Belinda for being involved in the final presentation for this year. We're looking forward to a full program of presentations next year. And Angus, we might tap you on the shoulder again, given some of your work, if that's acceptable.
Certainly. David, if I could just mention too, if anyone, the people who are present today and anyone listening to it, if they want to contact me about the project, just feel free to email me.
Thank you, Angus. That's brilliant. All right. We'll certainly make sure that goes out as well. Thank you again, everyone. Have a wonderful Christmas and look forward to seeing you in 2022. All the best.
You too. Thank you for the opportunity.
Thank you, Angus. Cheers.
Thank you. Bye.